Hi everyone. Today on the show Market Makers, we have with us Mr. Amey Sathe, fund manager at Tata Mutual Fund. Amey has an industry experience of over 17 years, and he has a strong expertise in BFSI, that is the banking and financial services sector. Welcome, Amey.
Thanks, Milan. Thanks for inviting me on this show.
It's a pleasure to have you on the show. Amey, so let's start our discussion with some fundamental questions. What are the key parameters that you would consider before investing in a bank or a financial service company?
So I think if you obviously everybody knows that BFSI as a sector is very closely linked to the economy. We have to start from the top. So normally what we do, we take a top-down approach first, that is a macro view, because it is very important to understand where are we in terms of economic growth, if the economy is going through a challenging phase. So that is a first critical step. And the reason I am saying is that even if in BFSI, you have a lending space and you have a non-lending space. Lending space is where you give loans, and non-lending space will have insurance, asset management, or broking related areas. So I will say more or less both segments are cyclical in nature. And that is why you have to see the top down, you have to take a top down view to understand BFSI sector. So what we do here is that we first of all take a macro view. How is macro looking like? Where are we in terms of economic growth? And economy normally goes through three phases. One is upturn, second is a period of very, very strong growth, and third is more of a downturn. And we have to position our portfolio accordingly. The reason I'm saying is that whenever there is an upturn or there is a sort of a strong economic growth phase, what happens is that you will see most of the companies actually doing reasonably well. And when you go through a phase of, say, downturn kind of economic phase, you will see very few selected players actually doing well and remaining players probably struggling. So that is a one starting point of looking at BFSI stocks, that where are we in the macroeconomic cycle. Once we do that, then we look at the individual segments, because in lending space also you have got many types of businesses. You have consumer durable loans financing players, you have NBFCs which focuses on housing, then you have vehicle financiers, you have banks which do credit cards or some other retail loans or even corporate loans. So we look at the various segments, and there also we see where are we in terms of cycle. Normally our preference is to buy companies when the cycle is bottoming out, because that is the point where you will get your valuations which is in your favor. And that is also a period where you will get profitability becoming extremely depressed. And what happens is that there is a tendency to extrapolate. So when profitability depressed, people sort of project that this will continue. And that is when you get valuations in your favor. So that is a point where you try to enter some of these stocks. And that is how sort of you can generate an alpha in the sector. Broadly, this is what we have done over last 6-7 years actually. Because if you see the economic, so we have a one banking fund probably which is a sector fund. It is around 7 years old. First 4 to 5 years were actually spent in protecting in terms of in investing very, very quality franchise, because that was a phase where economy was going through a lot of issues, lot of challenges. And last 2.5 years were the period where we actually focused on some of this economic recovery kind of a period. And that is how we position our portfolio. So broadly, this is how you look at BFSI stocks. And obviously you'll have your own filters of, say, corporate governance, profit pools of various individual companies, their strength, where are you in the cycle, what are the valuations. Those parameters also come into picture. But mostly I will say these three things that determine. One is your macro approach, second is where are you in terms of profitability, and third is where are you in terms of valuation.
Superb, excellent. So as I understand, your entry point typically would be when the profits are depressed and the market is extrapolating those depressed performance. But that's where some kind of turnaround happens, and that's where your entry point comes in. Is that correct?
Absolutely. And there are a lot of leading indicators also. So nowadays in lending space, especially what you have got something called loans which are due 30 days dues or 60 days dues. Some of the entities report loans which are dues even 1 day is due. So that kind of a leading indicators you have. So that actually helps to see wherever any turnaround is happening. Not only that, you also have a lot of past historical trends. So when you look at, say, BFSI, we have entities showing results for almost 25 years. So you have almost now 3 cycles for almost most of the companies, how they have behaved, how cycles have behaved. So that also help us a lot in terms of taking our decisions. And what we always believe that you also have to see where is the ownership, because many times when a sector goes through a prolonged pain or prolonged slowdown, we tend to see shareholders or equity holders avoiding that space. And that is also a very big important driver of stock prices. If you get in early, and if your call plays out, what is going to happen is that you will see newer set of investors coming through and sort of driving up the price upwards.
Interesting, pretty interesting. And so this is about, entering a new stock or certain categories within the BFSI sector. But what kind of indicators do you monitor once you've actually entered a stock or you have already invested?
Yeah. So in the investing process also, there are a lot of channel checks that we continue to do. So because many times management tell us one part in our whenever we meet them, but when you actually go and visit their branches, or you talk to DSAs, which sort of they rely on for origination of loans, or you talk to the customers, so you get a lot of insights, and you can always corroborate what the management is telling you and what is actually happening on the ground. So this is a very continuous process. Even if we stock holds in our portfolio or not, this process goes on. If you're holding the stock in your portfolio, this becomes a extremely important step to sort of carry out. That is one. So that is more of a qualitative aspects of looking at the business. In terms of quantitative aspects, we look at 3-4 things. One is, how is loan growth panning out? Is loan growth above our comfort zone or below our comfort zone? Is it tracking as per what we discussed with the management? That is one. Secondly, how is asset quality trends panning out? Are you getting a feedback from the ground that whether the company is taking a excessive risk or not? That is the second. And if it is taking a risk, how is it pricing the risk? That is also very, very important. So that is also second parameter that we look at. Third, in terms of profitability, how are margins holding up? Whether company is investing for a future growth or not, because many times company has to keep invest when actually what happens in a cyclical sector like banking, you have a phase where your credit costs are going to be significantly low. In that period, company probably needs to invest in either in distribution or a technology platform, because that is how you will sort of use that excess profitability that you will have. So currently, as we speak, we are going through a very benign phase of asset quality. So the credit cost for the industry, for the sector also, is actually on a declining to stable kind of a trajectory. Many of the companies, investing companies that we have in our fund, actually are using those excess profits to deploy in the business, to add branches, to add manpower, to improve their technology platform. And that is how you actually prepare for the next leg of growth. And whenever cycle turns around, probably at is the point wherever your provisioning cost goes up, you sort of pull back on your OPEX. And that is how you sort of maintain your profitability over a cycle from an industry perspective.
Got it. And how do interest rates or any kind of regulatory change affect or impact your fund strategy?
Yeah. So interest rate is a critical component in a lending business, right? And normally when the kind of a loan mix as well as kind of a deposit mix some of the entities have, I think interest rates play a very important role. In a environment where interest rates are actually going up, what we see is that banks tend to benefit more because they have a relatively higher book which is floating in nature, or a book which is linked to the repo rate. While on the other hand, your liabilities take a time to reprice. So normally in the rising interest rate environment, you always see banks actually reporting a pretty strong margin improvement kind of outcome. But an environment where interest rates start to come down, you will see opposite of that. So when interest rates are going up, banks will sort of in a driving place. When interest rates start to come down, you will see NBFCs or HFCs. So banks are price setters, NBFCs or HFCs are price takers. So price takers will benefit in a falling interest rate environment. And that is where probably what happens is that when interest rates start to come down, many of the NBFCs have a fixed rate book. So their yields remain unchanged, but their funding cost comes down, which helps them in improving their margins from the relatively depressed levels. So that is where the interest rate environment actually becomes critical from a fund management perspective. So last 1.5 years, you would have seen a lot of banks have reported very good margins. And probably you will start to see some of these margins sort of coming down a bit in coming quarters. On the other hand, you will see this year a lot of NBFCs, a lot of HFCs actually showing a margin compression. But probably as interest rates start to come down, you will see some of these sort of margin compression getting reversed, and you will again see a environment where margins sort of improve from the from a lower levels.
Okay, got it. And for the benefit of our viewers, typically, these the retail investors, what are those leading indicators that help you, gauge what could be the trend in the interest rate, whether it could go up further or reverse? Any leading indicators
I think
that help you?
yeah. So I think so in India, sorry. So I think Indian economy is also becoming is getting linked to the global economy. So we are not in a phase where we will be decoupled from any of the external environment, right? So we are very much coupled with everything, which also means that if tomorrow US Fed raises interest rates by say another 50 basis point, I think RBI will also have to come in and probably will have to match that action up to some extent. I'm not saying that we'll have to increase by that much, because the gap between their interest rate and our interest rate will be very small, and then you'll have to sort of to maintain exchange rate parity and all. So you have to maintain that interest rate gap. So clearly that is a one indicator that how US Fed is sort of reacting. That is one. Secondly, domestic, if you want to see, you have to see how inflation is panning out, because nowadays RBI gives a range of comfort zone for their inflation. So we have moved to inflation targeting kind of a mechanism. So wherever you see CPI or WPI number, which sort of get released on a monthly basis, you see those levels, and you can always sort of react whether RBI will increase the rates or not. There is a monetary policy which happens every 2 months. There is a press conference which is done by RBI governor. Again, a very excellent press conference. I think if one can spend even 1 hour on attending that press conference, it is an ocean of knowledge. It's an ocean of information. And so these are some of the things that as an investor we keep looking at, keep reading articles of governors. So many times nowadays, RBI actually puts up the speeches given by governors, deputy governors, where they actually talk about their thought process on interest rate or any other issues facing banking sector. So that is also now becoming a very, very important source of information from our perspective.
Right. And, how do you assess or say manage the risk of NPAs in the portfolio companies?
Yeah. So I think so at the point that I talked about, that we keep sort of visiting branches, we keep doing those ground checks, or talking to DSAs or talking to say credit information bureaus, which give us a lot of data point, a lot of quality information. I think one way to sort of avoid asset quality problem risk is to monitor the macro indicators. I think that is the best way to remain ahead in this game, because otherwise many times what we have seen, even managements also probably not necessarily will be will sort of will be telling you the first that there is going to be a problem. There are a lot of leading indicators that you can see on the ground that you have to keep following. I think there is one more, probably there are two big changes I will say that have happened over last 3-4 years especially. One is adoption of technology by almost all the lenders. Now data availability is on a real-time basis. So when a CEO of a bank or NBFC or HFC reaches office in the morning, he gets a dashboard which talks about what are the 1 days past dues or 30 days past dues, which location, which branch. So now availability of information is becoming a very, very easy, and also the quality of information is also improving. So my sense is that nowadays managements are significantly on top of these issues of asset quality, and whenever you see some bit of a flare or some bit of a abnormal increase in asset quality, they react, they get down to the action. So that is one big change that has happened. Second big change that happened in my view is that the role of regulator. I think RBI has done a phenomenal job. You would have seen their risk reports or their annual auditing. Nowadays, it's a concurrent audit. So it's a parallel audit which goes on by the RBI. So RBI knows what is happening in the books of banks. And RBI is nudging banks. Okay, we are seeing some bit of a risk building up in this segment. You lower your sort of exposure in that. So there are a lot of nudges given by a regulator also. And that is also helping banks. There is again a real time reporting of any default which is happening, especially in a large corporates. So every day regulator is getting reports on those things. I think these are all very critical aspects of the business that have improved over last 3-4 years. And so our sense is that next cycle, obviously there is going to be a cycle. We are not denying that, but it will be at least 2 to 3 years or 3 to 4 years away in terms of sort of pressure getting built up on asset quality for the banking sector. You always have some pockets showing some bit of a irrationality, and my sense is that nowadays regulators or even some of the lenders also on their own correcting it, but clearly things have changed drastically, what we saw in the last decade and vis-a-vis what we are seeing in this decade.
True. Data is helping various companies, various stakeholders in taking right decisions. True. Okay. Now, moving on to slightly on the, stock price performance. If one sees, in the last 2 years, the shares of public sector banks have significantly outperformed the private ones. So according to you, what has triggered such a strong investor interest in PSBs?
I think what has happened in last 2-3 years is that at one is their asset quality problems have been taken care of. So you would have seen public sector banks went through their own share of issues, especially starting from say 2013 to 2021, when we had a first big NPLs coming from say power sector, then telecom sector, then we had Demon, then some of the large NBFCs went bankrupt, and then followed by a very painful period of COVID. And what has happened is that in that period, banks recognized a huge amount of NPLs, and some of the NPLs actually were NPLs not because the project was bad, but probably the promoter was irrational or reckless. And in the meantime, we also saw a very big law which is getting cleared by the government, that is IBC. And that has helped banks to resolve some of those exposures. So you would have seen some of the NPLs which were amounting to 40,000, 35,000 crore were actually resolved with 100% recovery. So their gross NPLs came down sharply. Their loan book growth started to pick up. So you would have seen loan growth for the sector actually came down to single digit by end of 2021. Now we are somewhere around 15-16% kind of a system loan growth. So you would have seen a lot of PSU banks have also, which actually degrowing their balance sheets, they started to grow. And you also had a benefit of interest rate environment where rising interest rate, as I said, actually benefit their NIMs. So there was a NIM expansion. So what happened was that when they started this journey of showing good growth, that the starting point, the earnings was very depressed. Many banks were doing only 40 bips, 50 bips kind of a ROA. PSU banks I am referring to. Yeah. That 40-50 bips ROA is now almost 90-95 bips kind of a ROA. So you are looking at a doubling of profit. So what are the share price increase that we have seen for the public sector banks? I think also it is driven by, one is depressed earnings and also depressed valuation. So now we are seeing a phase of normalized earnings and normalized valuation, and that is why the share price performance is also reflecting that. On the other hand, private sector banks were a lot more steady. So they did not have, so there was also issue that they were really over-owned because that was a space which was doing well. So probably everybody had it in their portfolio. PSU bank was really, there were a lot of naysayers or disbelievers on this, that people, because last 6-7 years before this have been very painful from an investor's perspective. So normally there is always a skepticism when cycle actually turns for good. And what you need to be careful only when that skepticism becomes confidence and overconfidence. That is a phase where one needs to be little careful of.
Interesting. In fact, the story of these public sector banks perfectly fits the strategy that you explained earlier of the depressed earnings, sentiment weak, and all. Nice. So now, if one sees Bank Nifty today, it is not very far from its all-time highs. So while this scenario is very encouraging for an investor who's already invested, but what should a new investor do at this time?
So one thing I will suggest is that don't look at the index level simply because earnings are growing. So if every year, if someone is growing its earnings at say 18 to 20%, so logically every year his earnings will be sort of a new high for him. So end of the day, index is a reflection of your earnings, underlying earnings. So at this point also, what we think is that next 2 to 3 years, our expectation, or even you look at consensus expectation, earnings are likely to hold up quite reasonably. And not only that, if you see the valuation of BFSI stocks, I think barring few names, in fact, we are seeing a fairly decent time correction for some of the names which actually that are there in the market. And their valuations are actually come off. So despite reporting a fairly good number, strong numbers, it is not that we are seeing a valuation euphoria, or we are not seeing any excessive in terms of valuation getting built. So I will suggest it might be at lifetime high, but if earnings are going to grow at say 15-16%, whatever the consensus is expecting, if that continues, and if ceteris paribus, probably you are going to end of the day, stock prices are a function of earnings over a longer term. Near term, you will have a lot of volatility or a lot of noise coming through because whatever the issues. But a longer term, it is earnings that determine the stock price. And if earnings are likely to be there, I think logically returns should also follow earnings, and vice versa. Our sense is that at this point, valuation is fairly comfortable. In fact, I also manage one diversified fund, and when I look at other sectors, probably I find BFSI is the only space where valuation comfort is very much high. In fact, I will say not just a lending space, even a non-lending space, which consists of your insurance, asset management, that space also has actually gone through a fairly large period of time correction. You would have seen some of the stocks have not moved up for almost 4-5 years now, 3-4 years. So that space is also looking quite reasonably okay in terms of valuation. And underlying trends are still healthy. We are not seeing any concerns or challenges on underlying growth trends. So till that time, I think this is a sector. I think probably till the valuation is in your favor, logically from an investor perspective. So from an investor's perspective, I always believe that if you enter at a relatively reasonable valuation, I think normally the experience of investor is positive. Because valuation is something is sort of, if you enter at a higher valuation, because prices is nothing else but the technically future kind of a cash flow, right? In a way, how much you are discounting the future, that is what the prices are. So if you think valuations are reasonable, your returns will also be far better, and vice versa. So that is how I will put it. And this is the only sector probably we see valuations remaining. In fact, valuations are below pre-COVID level for many of the names in the BFSI sector.
Interesting.
And which we haven't seen in other sectors. In fact, in other sectors, valuations have actually gone up compared to pre-COVID period.
Definitely. And nobody can deny the fact the valuations that are there right now for certain small cap and mid cap stocks.
Or even, yeah, absolutely. Yeah. So that is at the market level. Yeah, that's true.
Right. And any emerging trends that you are seeing, or it could be even risk that investors should be aware of, especially in the banking sector?
I think in terms of trends, I think what we are seeing is that the companies are willing to invest in technology. I think what happened in 2021, where there was a genuine sort of a threat coming from fintechs, I think that made a lot of lenders, or even a lot of BFSI companies, realize that you cannot cannot leave. You cannot leave this space. So you have to be there. So you are seeing a very sharp increase in investment done by some of these BFSI companies, which is a one very good trend. Because what will happen is that the benefits will start to flow at some point of time. And we are already seeing some companies actually showing improvements because of those investment that they have done in last 1.5 year. That is one. Secondly, I think the environment is becoming a lot more competitive. Competition is fairly intense. PSU banks are now giving a very healthy competition to private sector banks, which even private sector banks would not have seen in, say, probably since 2015. So that is one important change that we have seen. Even those banks, PSU banks, are also now getting people from market. We are seeing a lot of PSU banks appointing chief digital officer or chief risk officer from private sector. So clearly their DNA is changing. So competition is becoming a fairly intense. So what you need a agile kind of a way of operations. You cannot be rigid. So whichever companies are able to respond to those challenges, I think will do well. Companies which focus on, say, building a liabilities management, I think those companies will do reasonably well in coming quarters. Because if you want to grow, see what was happening till now, that banks were sitting on a fairly decent excess liquidity, because during COVID times, loan growth did not happen, but deposit flow was quite healthy. So banks were sitting on a very low credit to deposit ratio, where you have 100 rupees deposits, but only 60 rupees have been lent. That picture is no longer in existence. So we are seeing many banks now. Some of the private sector banks are almost 85% plus. Some of the PSU banks crossing 72% plus kind of a ratio, which means in coming quarters, if you want to grow at 15-16%, your liabilities also will have to grow by 15-16%. So liability generation and focus of those managements on those liabilities also become a critical. And last and probably the most important thing is the asset quality. I think every company will have to be on top of asset quality outcome. Last cycle has been fairly painful, which was dominated by corporate. This time around, we are seeing a fairly benign environment in terms of corporate asset quality. It is a retail something that we'll have to see how it pans out. Although having said that, I will say COVID 2 waves were also quite severe, which actually cleaned up a lot of retail portfolios also. So we are just building up a new sort of, I will say, credit portfolio in terms of retail also. So clearly asset quality risk is something everybody, every lender or every investor should be mindful of. And that is where I think it becomes critical that how fast you are growing. If you are growing in the region of, say, 20 to 20, 25, 27%, I think this is a very reasonable growth where banks can manage their liabilities. Banks can also manage banks in the sense lenders can manage their liabilities as well as manage their asset quality. Because normally capacity building, when any company does, it does it for probably this kind of a level only. And that is where comfort also lies. If you grow at a relatively faster pace than the system or significantly ahead of the system, that is where the red flags start to come in.
Got it. Interesting. And let's say if one has to take a slightly longer term view, let's say about 3 to 5 years, what is your outlook on the BFSI sector?
Currently, where we are at this point, so our outlook is quite positive, simply because of probably I will say three main reasons. One is that your valuation is in your favor. You are not entering a sector where there is too much of euphoria. In fact, you are entering a sector which has gone through a fair bit of a actually correction in terms of time correction, or even some of the cases price correction also. That is one. Secondly, which is equally important, is your earnings growth. Earnings growth is expected to remain quite healthy, and there is a fair bit of a visibility on earnings growth. Till the time earnings growth hold up, I think sector should do reasonably okay. That is the second part. And third part is that I think last cycle has been very painful. So it lasted for almost 8-10 years. Some people call it as a lost decade from a Indian economy perspective, because after every year we had one or other some issues that we want to. So our thought process is that next cycle probably will be 4-5 years away in terms of challenges. And not only that, we also take a lot of confidence from the so till now what you would have seen, large part of the growth would have come from a consumption or the retail loans. For the first time, we are seeing actually sanctions for corporate or project loans actually going up in double digit, growing at double digit rate. So normally sanctions to disbursement, there is a lag of, say, I will say 3 to 4 quarters, depending upon the approvals and all. So if corporate capex also picks up, and by the time hopefully we will also get some more clarity on global growth, I think we are domestic economy wise, we are probably somewhere in 2003 kind of a period where it was actually quite similar period where we came out of the very bad NPL cycle. Loan growth was subdued, and all of a sudden what we saw, huge corporate capex coming into picture, where you would have seen infrastructure projects getting launched and a lot of loans getting sort of loan growth coming back. At that point, what supportive was the global growth. So if we get global growth also in our favor, which I hope hopefully next 9 to 12 months, we will see some bit of a resolution coming through, on some idea on that coming through. I think this is a sector which logically should do well, because it is linked to economy. So if economy does well, this sector will do well. And there's one more aspect. This is also one sector you will also see a lot of FII participation actually. So you would have seen last year when FII sold some 3 lakh odd crore. If I'm not wrong, 50% were from BFSI sector. So whenever FIIs actually come back, I think this will be the sector where they will come back, because this is a sector which is fairly liquid, and this also gives you a fairly direct play on Indian economy with quality management, good corporate governance, and very good scalability. So clearly, if whenever those things start to fall in place, I think you will see BFSI sort of doing well. It is linked to the global outcomes also. So whenever you see volatility in global markets, you will also see volatility in Indian markets, and that is mostly will be obvious in Indian BFSI sector. So whenever you see opposite of that, I think that is when the sector will start to do well. So in that sense, in next 3 to 5 years, we are fairly comfortable on the growth trajectory. We are fairly comfortable on valuation. And we always, so if you look at last 5 years CAGR return, you just see which sector has delivered the least. So out of the 6-7 sectors that you have, the major sectors you have, BFSI will be somewhere in bottom 2. So that is normally a good indication that sector has gone through a fairly long, prolonged, painful phase. And if investors have long-term focus, I think this sector will also give healthy returns in coming forward, assuming whatever we discussed over last half an hour sort of play out in terms of economic recovery, global environment stabilizing, and corporate capex coming through.
Got it. Fair point. And while the outlook is optimistic, according to you, what could be, if at all, global economic risk or any geopolitical events that could derail this optimism? And especially in such scenarios, how do you as a fund manager try to mitigate those risks?
So I think geopolitical conflict is always a risk. Similarly, global uncertainty, say with respect to say commodity prices or interest rate environment, that is also one big uncertainty. In fact, last 1 month you would have seen crude oil actually rallying up almost 30-35%, and that definitely upsets India's calculation in terms of say current account deficit or probably balance of payment or some of those aspects, or in terms of inflation trajectory also. So clearly those issues in fact hurt a lot in terms of overall, because it's end of the day all these have an impact on economic growth, and BFSI is completely linked to the economy. So if whenever economy does well, as we discussed, BFSI do well. So all these points that we discussed of geopolitical conflict or war or sudden spike in say commodity prices, it has an impact on economy, right? And naturally, quite naturally, that it will have impact on BFSI. So we'll have to, so that these are the definitely risks. There's also a risk of, say, we have an election coming through next year. That is also a very big event from a market perspective, and FIs are keenly watching the outcome. So that is also one big event to track. I think, and in terms of portfolio mitigation, we normally go by the valuation levels. So last 2 years, what we did, we had a fairly large exposure to some of these beaten down names, or the point that we discussed when we try to buy stocks which are depressed valuation and depressed earnings. So that helped us, and probably now the valuation comfort probably is definitely, which we had probably 1.5 years back, is coming down. So clearly now there are new areas where we are seeing a fairly decent valuation comfort. So slowly we are sort of shifting some of our exposures to those names where we think that that price correction has been quite severe, and negative news is fairly priced in. And that is how we sort of mitigate our risk in terms of portfolio exposures.
Got it. Pretty interesting discussions with you, Amey. Thank you so much for taking out time for this session, and we'll look forward to having you, again sometime in future on this show.
Absolutely, it was great talking to you, and it's my pleasure to be on this show. We will look forward to future engagements.
Thank you, Amey.
Thanks. Bye. Take care. Bye.
Bye.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.